So all of these reports out of the White House coming during another wild day for the markets and your money, because let's face it, on any other day, an 1,100-point gain for the Dow would be huge news. Cheers all around, leading the nightly news. Today, though, no other day. It was a day following a 2,000-point drop and one of the biggest percentage declines ever. So while today's move was certainly comforting, it did erase just about half of yesterday's losses. The Dow still down about 12% this year. In other words, today was much better than yesterday, Tim Seymour. But should anybody feel particularly good right now?
You should feel tired. I mean, you know, think about the volatility we've had intraday. So we traded down 4% out of the gates off of what had been optimism. And Eamon just talked about these are the kinds of ideas. This doesn't, you know, I feel like we've been down this movie. We've seen this movie, been down this road, pick your metaphor. But I'll leave that aside for now. We then rallied almost 5.2%. The most impressive things and the things that would give me the most comfort were we've essentially had a 50 basis point rise in the 10-year note. So essentially almost a 3-point sell-off, which is unheard of. You thought that the rallies were unheard of, at least in one day. You'd think the world was coming to an end if we were at normal pricing. The dollar rallied, which perversely was almost a risk-on moment. It's usually a risk-off moment. And the yen sold off 3%. So we continue with the hyperbole in terms of what the market is doing. I think until credit begins to settle down, it's very difficult. And we could have said this a week ago. Day traders having a great time. Knock yourself out. These are dangerous markets.
Yeah, and I want to show, if we could, guys, put up the JNK, which is that junk bond ETF that we talk about, because we've been talking about credit. If you look at this, pay attention to something tonight when they mark to market. See if this ETF goes below its net asset value. It continues to fall. Remember, it's held junk debt. If junk debt is not liquid, Karen, and this ETF is supposed to be liquid, it's just something to watch about the net asset value of some of these widely owned, high-yielding ETFs. Something on my radar. Is it something on your radar?
Absolutely. I mean, HYG, we've talked about a lot.
Explain what dropping below NAV might mean, because I don't think a lot of people understand that.
Well, so this portfolio owned, I mean, this ETF owns a portfolio of junk bonds, right? And they are marked at supposedly wherever they trade. However, if you get in really illiquid markets, you can see very wide spreads for where any given underlying bond could be. I mean, so the HYG is very similar to the JNK and that they're junk bonds, so they're below investment grade. And as we see, even with rates going down, credit quality is starting to deteriorate, so the HYG is going down. I've been short this for a while against, for example, I'm long banks, so short this. But now I tried to short more, and I couldn't get a borrow anymore. So
I could not. What does that tell you?
That tells me that the short is getting crowded. So I want to remain short, but I got to be aware now, okay, this isn't like, wow, that was an interesting risk reward. The risk reward's changing now. It was 89 10 days ago. It's 80, I don't know.
Still have value?
82. I think things could really get uglier, but it's a 7-point move in this index is really a lot. The investment grade index, LQD, is another one. Short that rates moved today, so it should go down, but it went way beyond the move in rates.
So what's interesting about this and what Karen said is that you can't get a borrow and it's hard to short HYG at this point in time. What a lot of people do, because this is highly correlated to the stock market, is they'll use S&P puts or S&P futures. So that's the link between the bond market, the junk bond market, and the S&P 500. So if you can't hedge out your junk bond exposure, you go and you sell S&P futures, and that adds selling pressure to the market. So besides just kind of the credit qualities and the concerns about oil companies going out of business, there is this kind of mechanical selling that goes on that investors need to be aware of as well.
And that is, BK, you nailed it. I mean, I think, you know, when we're all on the phones.
As you do.
We're all on the phones all day long. And everybody you talk to that's deep in the market, and we're a TV program, so we have to sort of speak in a more general way. They're going into these things about what's happening in the internals of the market. I'm thinking, well, how could I explain? First off, I'm not sure I understand it. Can I explain it on the air? What you said between the credit markets and equity, forced selling on the S&P, because you got to raise cash in any way you can.
Raise cash or hedge a position that you can't sell short. So, you know, let's just say, example, it was IBM and you couldn't sell that short, but you needed to hedge it for some reason. You could then go and sell short S&P, the SPY, the ETF. You could buy puts, and that would put pressure on the entire market. Even though you're just trying to hedge out the IBM, you're actually impacting the whole market.
Gosh, Jeff Mills, I forgot that we went up 1,100 points on the Dow today.
I know.
Is everything okay?
Everything is probably not okay. You know, you tend to see these moves after big down moves, and yesterday was certainly a big down move. But to get back to credit, it's not just high yield. There's a relationship between the price to earnings ratio in the S&P 500 and investment grade credit as well. So I brought a chart along. They can probably put it up. But if you look at investment grade credit spreads, they're typically pretty highly correlated to the PE in the S&P 500. So as credit spreads start to blow out, as there's stress in the credit market, investors are willing to pay less for their equities. What you've seen happen recently is a little bit of a gap. So that chart you're looking at right now, the orange line is credit spreads. It's actually inverted. So that means credit spreads have blown out. There is now a gap between the PE ratio, so the valuation at which the market is trading, and where investment grade credit spreads are. So based on current credit spreads, that would foretell a PE ratio of about 14.5 times in the marketplace. So you take 14.5 times, you multiply it by forward earnings, you're talking about a level around 2,500 in the S&P 500. So obviously this isn't the only thing you should be looking at, but in terms of trying to pick a level and to look at the credit markets and figure out what they might be telling us, I think this is an interesting relationship.
Let's quickly go around the horn here. Do you buy anything today, BK?
Puts.
Again,
Yes.
betting against the market.
I put them out again. Yeah, absolutely. I think, yeah.
No, tried to short HYG.
And so that's all you did today, just watched.
Basically, yeah. Think about what do I want to own and where. I hate days like this. I hate buying stocks on days like this.
Why is that?
Because it feels like a sort of suckers rally or sort of, I don't know. It just seems like
it's just unsettled,
yeah.
and I think you're getting mixed signals, too. So if you look at the options market, put-call ratio is blown out, so there's stress there. So that would be a good sign that maybe you could come back into the market. But if you look at positioning, you're still not seeing the net shorts that you would typically see in this kind of a market. And you also haven't seen sentiment come back. You know, we're looking at just survey measures of sentiment. I think there's still more wood to chop there. And also on the valuation side, I think there's more room to the downside.
Well, so the VIX closed at 47 today. So it's not like we're not in elevated times. But I was actually nibbling some index exposure for clients. Remember, what we're saying throughout these difficult days, though, is you have to have a plan. You have to have a context for where valuations make sense. It's one of the reasons why we're going to talk about 4 stocks later on in the show. But at some point, look, I look at the charts, I look at the levels, and in the current credit environment, even though I am concerned and I don't need to wholesale buy stuff, I think 2,700, 2,750 is kind of where we're headed, or 2,650 if you look at the weekly moving averages. So I don't want to get into that. You were asking me what I was doing. I do think if you have a plan, and if there are people that have some cash to put to work, I don't think you need to time this market perfectly. In fact, I would urge you not to do that.
Yeah, and listen, we went up 1,100 points, not making light of that. Bespoke Investment Research noted this incredible, folks. This is the 10th time out of 10 times the S&P has risen more than 2% following a Monday 5% drop. So this bounce was all but guaranteed, according to history.